What's up, guys? Today we're going to cover Unit 4, Financial Sector, topic 4.5, which is the money market. All right, so the demand for money. At any given time, people are going to demand a certain amount of liquid money, and they're going to demand money for two reasons, right? You're going to need cash for two reasons. One, transaction demand for money. So people hold money every day to make transactions, right? So like when you go to lunch, you're going to need some cash to pay for lunch. So you're going to have that transaction. You're going to have some demand for actual physical money, right? And then asset demand for money. So people hold money to hold money since it's less risky than other assets, right? So if you're a little weary about what's going on in the stock market and you don't want to invest in the stock market, or you don't want to buy bonds, or you just want to be a little bit more cautious with your money, you just put it in a bank. It's not going to gain a lot of interest. But again, that's your opportunity cost. Is you're putting it in the bank. It's not going to gain a lot of interest, but you're also going to be able to access that money very quickly, right? So that is transaction demand and assets for money. So what happens to the quantity demanded of money when interest rates increase? Well, if interest rates go up, right, quantity demanded falls because individuals would prefer to have interest-earning assets instead, right? And then what happens to the quantity demanded when interest rates decrease, right? Well, when interest rates decrease, then the quantity demanded increases. There's an incentive to convert cash into interest-earning assets. So essentially what I'm trying to say here is there's an inverse relationship between interest rates and the quantity of money demanded. So interest rates go up, right? Quantity demanded falls. Interest rates go down, quantity demanded increases, right? Like if interest rates are up, you're going to want to put your money in the bank so that you can gain interest off of that, right? Now, let's go ahead and look at the graph, the money demand graph, or the money market graph. So all right, so here we have nominal interest rates. That's going to be on our vertical axis, right? And then we have quantity demanded of money. And again, as we demand more, as interest rates fall, we're going to demand more money, right? As interest rates go up, we're going to demand less money, right? And so, and we can see that pretty clear here, right? Now, this is our money demand curve, right? Now, this curve can shift either to the right, increasing, or to the left, decreasing, and that can be shifted for three reasons. One, price level. So if price levels were to increase, right, we're going to need more cash to make our transactions, right? If there's an increase in income or a change in technology, right? So again, change in price level, change in income, change in technology, that'll shift the money demand curve, increasing to the right, decreasing to the left. Okay. We also have what is called our supply curve on this, right? And again, this is going to be another horizontal curve, right? I'm sorry, vertical curve. And this is set by a non-partial group, right, or a government office, the Federal Reserve, right? And the Federal Reserve, they set the money supply line, then in turn setting the interest rate based off of how much money is in the market. And we can, of course, shift this to the right or shift it to the left. And if money supply increases, there's going to be a temporary surplus of money. There'll be a temporary surplus of money. So let's look to see what happens if we shift this to the right. This is an increase in the money supply. So what happens to interest rates? Interest rates fall. And if interest rates fall, what's going to happen to AD or to our GDP equation? Well, if interest rates fall, then investment is going to go up, and because investment and interest rates are inversely related. So investment goes up, GDP goes up, and so that would move aggregate demand or our GDP equation to the right, increasing aggregate demand. So this is going to be used a lot with your ADAS model. with the Federal Reserve, right? Or Federal Reserve again dictating the money supply curve. Okay, and then so same with decreasing the money supply curve. So the Federal Reserve wants to decrease the money supply curve. They'll come over here, decrease it, and that would increase interest rates, right? So the Federal Reserve is going to, during a recession or when we're in a trough, they're going to want to increase the money supply by lowering and then effectively lowering interest rates, and then investment and consumer spending should increase because interest rates are low. And then in a peak or in an inflationary gap, the Federal Reserve would then want to lower the money supply curve or decrease the money supply curve, because then that raises interest rates. That's going to lower investment. It's going to lower consumer spending, and it's going to slow down our economy. And so that's going to be it for 4.5. Thank you guys for listening, and we'll see you.